You should all get notified that we are going to record this session. One more minute and we will get rolling. Feel free to use the chat feature for any questions you don't want to jump on screen or voice. Questions, thoughts, ideas that we do not cover here today, we can always cover in future sessions. So as you kind of have complexities, or as we dive into investment principles today and kind of the beginning of a portfolio, as we look at moving forward, one of the topics, a few of the topics may say, well, how does that connect with tax strategy? Or how does that connect with ongoing life decisions and processes? How do I dive deeper into this subject? Without further ado, because I want to be very conscious of everyone's time, we are going to get rocking and rolling. So anybody who joins us, we will let in, but for the time, appreciate your interest. And the next 40-45 minutes will be an instructional overview of how to begin in the investment atmosphere. How do we begin with some investing principles, and how do we really start to develop a strategy and a portfolio that is going to align to both our wants and our needs as well as we look at this investment journey. Always want to start with an opportunity to ask questions. Opportunity will remain open throughout the program, so by all means, chat or interrupt me. Anything to kick us off? Any major questions that we want to make sure to address today? Then without further ado, we will get started. Let me admit one more and then share my screen. All right, can I just get a thumbs up that you see the screen? Nice. Excellent. Couple tardies being admitted, and we're off and running. As you know, my name is Jedediah Collins, and I am going to be your guide on this trip today. I'm a certified financial planner. Want to point out this is not going to be financial advice. I don't know you. I don't know your situation. I don't know what you should or should not buy. These are going to be principles and concepts that you're going to be able to take with you to make your own decision, which is the best part of education as it does begin to empower us. The content and the subjects, already a good first chat. Yes, we can address 529s towards the end of the session. That's a great question. Today, we're going to go through some investment truths. As everybody ventures into this territory, they see the overwhelming world of investing, and we want to get to some of those fundamentals that you can hold on to as you begin to develop a plan. What type of an investor are you? How to begin to really look at your portfolio. One of the reasons why we love consolidation is to see that holistic view and understanding. And then as you look at possibly growing and getting more advice, we'll kind of go through some of the ideas around that. But I love to lead out with our goal. You want to write something down, you need to develop a personalized investment philosophy that answers the question, why? Why are you investing? A very simple one could just be to overcome inflation. Another one could be to reach, freedom, whatever that means to you. But as we look at it, our investment strategy, our entirety of our plan should always be that we have the ability to spend more and more as we progress. This seems like a generalized and easy concept, but truly driving towards the idea of investing is to not have your portfolio double this year. It's not to get 40% returns in 2 weeks. It is simply to continue to grow and provide for you and your lifestyle. I think we all need to remember that at times, especially at this moment in time when the market is not doing as well as everybody would hope. We just need to be able to look at our plan and see we are headed in the right direction. We're going to go through these investment truths. Number one, we're going to start out with a very fundamental understanding that this world that we belong in, capitalism, it is a generational wealth creator. As we look at this, the ability to buy and sell for individualized profit and gain is going to be a game we have to participate in. That question I asked earlier, why are you investing? One of them is, in today's financial world, you are forced to invest. If you do not invest, you're going to end up losing. So as we look at capitalism and this industry that we are playing in the financial sector, you need to see inflation, that first line item right there. On average, 2.8929, you can just estimate that at 3%. Sure, the Fed and the world wants us at 2%, but that is the reason right there why we need to begin our investment journey. As we go to the right, you'll see this increase in returns as well as risk, and that is something that we will bring up in a later slide. But this general introduction, why are you investing, is because the capitalistic market, the one the United States and the world currently are engaged in, creates wealth. All the way to the far right, you see these large, mid, and small cap stocks. Very simple to understand those. Those are just the size of the company, large, small, mid. And as you go farthest to the right, small cap, because it has the highest risk, also has the highest long-term payoff. That connection is going to be portrayed throughout this, but I gotta begin with just that fundamental understanding. Putting your money at risk produces results in the capitalistic market. For everyone, absolutely not. For you right now, today, I don't know. Over the long haul, this strategy does pay off. The second thing, as we understand, hey, the capitalistic system is going to produce results, we also have to transition and start to fundamentally understand that it is not an average return. The market does not stay at their average, does not stay at a monotone kind of return. It is volatile, it is up, it is down. It is going to be a chaotic journey. What we do want to point out in a slide some of you may have seen, but I just love to share, is as you look at this journey, as you start to understand the market returns X percentage, it doesn't and definitely won't do that year in and year out. This next quarter, this next year, where the market is being anticipated to be lower than our average, is part of the equation, part of the formula. As you will see right here, over 100 years, the market returns about 10%, but only 5 times. Only 5 times in this time frame does it actually get within 2% of that 10% average. So as you interpret that, as you walk away from it, you realize principle number 1, I have to play because capitalism creates wealth. Number 2, I cannot anticipate an average steady eddy kind of return throughout my portfolio. They are going to be highs, there are going to be lows. You have to build yourself both emotionally as well as structurally in your portfolio to withstand both. So this idea, the average, let's say we can count on 7%. You can count on whatever percent you are desiring. That comes with a fundamental understanding. It is not going to come every year. There are going to be ups, there are going to be downs. As you see that roller coaster, as you see this understanding of rise and highs and lows, you are now introduced to this idea that over a time period, the return will revert back to its average. As we just experienced, the last 8 years or so has been a higher than expected return, which if you look at the mathematical balance means we have to have something below our expected return to average out and start to see that over time. This chart, again, all these charts, a little confusing, but let me just explain what you're looking at. You're looking at the range of possible, returns from asset classes. Again, you see that one inflation on the left, you see US bonds, high yield bonds, which are a little riskier bonds, some known as junk bonds. And then global equities is simply the stock market, US and international. And as you see the black at the beginning, that's a 1-year return. What is the annualized return in a single year? Inflation, and this chart will be updated here shortly, 6% all the way down to -2. We've seen over 6% here this year. But as you look at the US bonds has returned all the way up to 30% and has barely lost much, -4 in a single year. Then you keep going and understanding the risk associated with excuse me, one more person here. The risk associated with stocks in your global equities. You see that 1-year return. You even see it over time. Yellow bar 5 years, gold bar 15, and then that red is the average. So as you look at the green bar of 15 compared to the red bar of its average, you'll see that the average continues to be reverted back to. You give it a time period. It is not the 1-year chaos. It reverts to its average over that time period. So if we are banking on capitalism creating, and we're understanding that it is going to be chaos, ups and downs, what we also can start to fundamentally understand in the investment world is that our returns will revert back to their average. If the United States stock market is minus in 3 consecutive years, you can hope over the next 10 years, it will be plus to revert back to its average. If vice versa, we had a 10-year positive, we have to inevitably have some negatives to revert back to that average and that mean. So this chart simply shows the wide range of 1-year, 5-year, 10-year time period returns, but how over that time period we can start to depend and count on the average becoming part of the equation moving forward. One of the mathematical rules I love to share is this idea of the rule of 72. And it simply says 72 divided by whatever investment return you are hoping for will allow you to see how long it takes your money to double. I like this because it shows the power of compound interest, why starting early is going to be exponentially more powerful. And when I say starting early, I don't mean the 22, 23-year-old just getting out of school. I also mean the 55, 56-year-old who is in that middle range, or that person who is starting to look at freedom years and saying, I may have 30 more years to live. I have a few more compounding periods that can double. So 72 divided by, and you can use this chart on the left. Let's say you were looking at that 10% return. 72 divided by 10 is 7.2. So I can see how quickly my money will double. If I have $50,000 today and I can get 10% returns, in 7 years, I will have $100,000. Maintain that 10%. In 14 years, I will have $200,000. So I can begin to see what elements of risk and return I want to start to use in my platform to be able to predict where my portfolio is going. Let's say I have a freedom number, round number. I hate using this example, but it is easiest. Let's say I need $1 million. I want $1 million to be financially free. Is that enough? Is that too small? Is that too high? Up to you, but let's just use it for now. If I have $1 million as my freedom number, and I can expect, or I can look at my portfolio and say, on average, let's be conservative, I want 5% return. I think I can get a 5% return pretty confidently in my portfolio. So that means 14 years, 14 and a half years. So if I want my freedom number to be $1 million and I want to achieve that number by age 70, that means by 56, I should have around $500,000. Maybe by 42, I have around $250,000. And that's with that 5% return. Of course, we want to exceed that, but you can start to see why some of our previous sessions have been so focused on your goals, your spending, and what you want from money. and how we're starting to look at investments specifically as kind of the engine to drive us there in our money vehicle. This is why we start to set goals. We can then reverse engineer how it is going to look based on a lot of unknowns, but based on being able to derive some mathematical formulas and some abilities to see where we're heading. No historical performance ever predicts where we're going, but it can give you some stars and some lights to be able to plan your strategy. I love saying past performance of investments is kind of like looking at stars in the sky. Stars in the sky are a representation of what's in the past. By the time those light hits you, you have no idea what is still there, but it still can guide you on a journey if you understand what you're using it for. That rule of 72, I really like. It's also a fun little party trick to tell people how quickly you know how to double money. So now that we see the ability to project, to start to see where we're going and understand a little bit more of that mathematical formula, we now have to back into the idea that this is not a guarantee. You take the biggest and baddest companies of the world at the moment in time today, Amazon. Amazon is a massive global empire, but they're not going to be there forever. You even hear their founder, their owner, former CEO, Jeff Bezos, say that day one mentality that the company was built on was to signify that every day we're just here to push the day we go into extinction one more day into the future. That is all you can do. This periodic table that kind of looks like a colorful blow up or throw up here is a representation from each year. How did these sectors, how did these investment categories perform over a time period? So these asset classes are represented by color. All you have to do is choose one color. Could be orange, could be green, could be black. Follow it across the timeline and you're going to see the roller coaster play out in real time. Every year, the rise and the fall, so many want to be able to say, oh, well, you know, if this is, so many want to be able to say, this is what we can predict. This is what we know. Well, as you see, this green starts on the top line and being the highest returns of the years, and oddly enough ends. It also has a lot of time down in the ruts, down in the minuses, down in the lows. You have to understand, not just companies, but entire asset classes are going to have positive years and they're going to have negative years. How you are anticipating this is through diversification. I love to point out this gold box, a moderate portfolio, which means not conservative, not aggressive. If anything, it's mildly aggressive. A moderate portfolio is never intended to be in the top 3 categories. You can't expect that. It's also never intended to be in the bottom 3 categories. That is the point of diversification. Your portfolio is being designed to have winners and losers at the same time in all times. That's a difficult concept to really understand. But as a former professional and advisor in this space, we'd have clients come in all the time and say, hey, this orange box, mid and small cap companies, this is down 15%. Sell those, they're a loser, get rid of them. We have to say, take a breath. We have those in there as a diversified portfolio allocation. Over time, the average return of that asset class is this percentage. So we're expecting it to return to that average over time. And if they did not understand, emotions got the best of them and wanted to sell, that 15% loser, the next year was up 36%. That same formula of low to high is seen throughout this table, which is why I love to share it as an example. You can see that green MLPs, oh man, up 44%. Let's buy more and more of those. Okay, 15%, 16%, good, 6%, not bad, working, bam. You lose almost a third of your portfolio in a year. So everything has a rise and has a fall. Your objective in your portfolio is to have the winners and the losers. You can rebalance, you can make them more efficient as you evolve, but looking at your portfolio and understanding, accepting the idea that you need to have some of these bottom categories. One of the first things we have to get comfortable with in the investment world is I have to own some losers. That's diversification. If two things react to a single event the same way, they're not diversified. They are meant to react to the same event. We increase the interest rates. We go to war. Something happens globally, a pandemic. They are meant to react differently to all situations. That is a diversified portfolio. So as you look at this, be able to identify, I want some winners. Obviously, we want the winners, but I have to see where my losers are and what their purpose is within building blocks of my program and my plan. So again, investment principles that we can adhere to. Your market leaders are not going to be the same. The biggest companies in the world are always eventually going to lose their hierarchy. If you're in the S&P 500 now, will you be in 10 years? That's a question. That is one we're already seeing play out. Some of the biggest companies in the world in 2010 aren't even in the S&P in 2020, and obviously some new companies have joined that fold, which is one reason why we like indexes. Questions, thoughts as we move forward? I love this little meme. This dude's very professional and a little bit confident in himself, but Skittles and M&Ms are never going to be enough. You need Oreos and those long-term fruit snacks to really spread out the risk of your asset class. Enough of that. Wrapping up, and we're going to finish here on the principles of investing and then pivot to more of building. But this is one fundamental that you've already heard in a few of them that is widely accepted, that risk and return are positively correlated. The more risk, the more possibility of the return. The more return, the more risk that there's going to be. But looking at this and saying one way to reduce the risk element but not impact the return is through time. How do I look at this? And pulls in that average reversion. The over time, it's going to revert back to the average. If you look at the time periods allowed to let dollars work for you, this chart is the cap, is the final chart you're going to see in this section of investment truths. But look at what it can share and show with you. That 5-year time marker allows for some growth. At 7-year, oddly enough, you see some retraction. I don't know what happens in years 6 and 7. That 10-year, you start to see the decade and go, okay, now this is why we're putting it. But not really until the time of 15 years. 15 years. That means today, we're looking at 2037. That is the investor mindset. This is one of the biggest faults people have as they begin this journey. The day trader, the Robinhoods, the apps that say, hey, what can you make tonight? What can you make this weekend? What can you make in the next quarter? What is your return based on this? Nobody cares about yield to date. That's not your goal. Your goal is, where are you in 15 years? Are you guessing still? Or are you in a portfolio and a strategy you are confident in? This one right here, that green, wow, how do we get in there? Those are the global equities, higher risk, as you see, higher risk, but higher over time return. The cumulative return of global equities cannot be disputed or debated in their ability to create and generate wealth, which is why it is so neat, because truly many of our families, mine included, are one generation away from never having been in the market, never having been investors. Many families are in their first generation right now. You may be the first investor in your family. In your family, you might be the first person that goes, look at where my money's going to be in 15 years. That thought has never been a concept in my personal family, which is what started my journey, but it is evident. Capitalism is going to do it. Time is going to do it. And as we start to understand our investment principles, we can take more and more of this road under our own control. So now that we have those investment truths, those pillars to make us a little bit more confident in just not running into this unforeseen, unpredictable, unknown territory of money, we now get to circle back to exactly who we are. As we look at becoming investors, we got to be able to measure, are we going to be a little more conservative, which means we're accepting less risk as well as less return? Or are we going to be comfortable with that being the ability to be more aggressive? Give me more risk in hopes of a bigger return. I think one factor you're going to see and understand is how you're going to make your choice is obviously that time one we've been harping on, but other factors to consider. So you look at time. Do I have 10, 20, 30 years to let these dollars go to work for me? If I do, I can accept more risk because we just discovered time helps us alleviate some risk because it reverts back to its average and we allow it to work in its own territory. Then you look at something like risk tolerance. Risk tolerance is an emotional decision. Risk tolerance, not risk capacity. If I have a $100,000 portfolio, I can't risk losing that money if I need that $100,000 to live on. If I have $1 million portfolio, I can risk losing $100,000 because I have that capacity. Tolerance, same scenario, $100,000 portfolio. I can tolerate if it goes down to zero because I know the risk I'm going for. I have $1 million. I can tolerate it going down to 900. I accept that risk. Tolerance is your acceptance of the risk. Are you willing to accept more or are you willing to accept less? That's up to you, and that gives you that horizon of where you want to be from conservative to aggressive. If you're saying, I want the highest return feasibly possible, I got to be able to accept the days, the months, and the years it goes negative, because that is the relationship I am accepting. And then your overall financial situation. If you're on first base, you don't need to hit a home run. If you're on third, you don't even really need that great of a hit. So looking at your financial situation, you got to begin to understand what you're able to manifest. Do I want to try to hit it out of the park and go great right now and accept the risk that comes along with that? Or do I look at it and go, my financial situation today, I live pretty cheaply. I don't, spend a whole lot. I don't need 10 gazillion dollars to be freedom. My financial situation says, give me $500,000 and I will be fine. That dictates your necessity to demand a return. Similar situation the other way. Maybe I have a couple years under me. I'm already ahead of the game. I already have $1 million portfolio. I don't need 100 million. Which one do I need and how much risk do I need to get there? That is your financial situation of where you are currently in your plan and your strategy. So the first and biggest is going to be that time. If you need these dollars, you cannot put them into the global equity market. We're going to explain exactly why even more here in a moment. Your risk tolerance. Do you stomach or understand what you are going to be doing as it is associated to your risk? Not your ability to withstand it, but your ability to stomach it. And then that overall financial situation is going to be an interesting one. As you look at what type of investor you are, you look at that first measurement of what kind of risk do I want to be connected to? And then you transition into, well, how are we going to go about investing? There's really three different atmospheres as you look at it. We're very often introduced to the first two. The idea of standing, and I'm a former athlete, so I like comparing sports, but it doesn't matter. You can stand in front of a team of employees, teammates, a classroom, it doesn't matter. You look out at your class and you think one of three things. If this is my team, I'm gonna need to go find some better teammates and players. We're not gonna be able to win unless I find better players. Second scenario, I look out at the team and I go, this is our group. This is what I'm going to go with. We can win a championship with these players. That third one says, as I look out, maybe I can move some of those players over here and have these players maybe try something else. And I'm going to try to improve and change the players that I'm working with. This is no different than as you introduce into the investment world. That first idea of I can find better players is going to be your active investor. That active investor believes the market is mispriced. Let me say that again. The active investor believes the current price is not accurate. They know something you don't know, whatever that is. They believe if you're selling it at 10, it is worth more than that. If you're buying it at 12, they're okay because they don't think it's worth that. They are contrarian to what you and the market are saying, and their fundamental understanding is, I'm smarter. I can beat the market. That is an active investor at their core. The market is wrong. I know more. I can beat it over the time, over today, whatever period you want. That second investor is more of the passive, looking at their team and saying, hey, I understand who you are. We're going to go ride with you. I don't need any new players. Nobody needs to change. Just sit there and do your job. Do what we expect you to do. A passive investor believes the market is priced correctly. There are no ways to make up money or find arbitrage or look at little nuances. The market is what it is. It is correct. And trying to beat the market is just not a risk that is worth taking. It's not going to pay off over time. This third and final investor is one we're trying to develop into. It's more that evidence-based, that hybrid investor that says, well, the market may or may not be correct, but it can be maximized. There are efficiencies that we can seek out when we understand asset classes, we understand diversification, we understand fees, we understand a lot of elements, but we can make our investment portfolio more efficient by utilizing and seeing things differently. What are the negatives? Well, we're going to talk about those more in depthly. The first negative to being an active investor, and again, I applaud anyone who is trying to be an active investor. Good luck, Godspeed. These next 3 slides are not going to make you want to be an active investor if you are questioning it. And that's okay, because you don't need to be. Let me repeat that. You do not need to be an active investor to be an investor. This first box just measures how many are likely to succeed. Let alone succeed, what about survive? If I'm looking at buying into an active fund, one that is going to turn over, they are based in New York City and they are mastering the investment universe. There are, a few hundred, few thousand of them. After 1 year, simply 1 year, a few of them have already failed. 96% is pretty good. But only 1/3 have actually outperformed the benchmark that they are competing with. 5 years, 4 or 5 have succeeded, have survived. 12% have beaten. 6, 7, and you go out to that 15 years, half are not even in existence of the active managers. And this is not you and me and our friend down the street buying and selling. This is institutional companies doing this on a daily basis at the very highest level of investments. Half are not in existence. You go internationally, you go to fixed income or bonds, half remains as the survivorship. So regardless of if you're winning and outperforming, just simply being around in 15 years is a very difficult task. When you start to look at how you've outperformed, well, that 10, 11, 15%, not very good odds of outperforming. And when we say outperform, you got to understand, I am paying fees, I am paying taxes to be an active investor. And what we're seeing right now is just the payout, the ability to maybe overachieve 10%, 15, 20% likelihood that the investment manager we selected is going to exceed. How much? By how much? How much do they have to exceed the benchmark for to actually return? Because if I pay them a 1% fee and then I pay active trading daily capital gains, short-term capital gains fees, taxes. Well, now I got to overcome both of those before I get an actual return. And you'll see again, 1, 5, 10, 15 years. This gray dot is the S&P 500, a benchmark for the United States economy. It remains in the top 25th percentile, even in the 10-year being in the higher range of the 25th percentile. So as you can see, not paying an advisor, simply going into an index is going to return you in the top quartile of investment returns without being active. Once again, you do not have to be an active investor to succeed in the investment world. And the last one, because I get a lot of questions, so, well, okay, if you choose one investor, I get it. Maybe that group, those people, they failed, they didn't do, but what if we level it out and we go with two? But sure, one of the two is going to hit crazy returns and grow. Oddly enough, your percentage and odds of success go down. If I choose two active investors, it's not like they balance out and one hits a home run. Sure, sometimes somebody's going to hit a home run, but if you look at the 44,000 different combinations, you start to see your performance decreases significantly, not from a very good outperformance of 17%, but all the way down to 7%, because you double the odds of being one of them that doesn't even exist in 15 years. You double the odds of this being a very, very hard and difficult game and just people not being able to find success at it. So what I want you to take away from that is you as an individual need to measure your time, need to measure your risk tolerance. What can you emotionally stand? And then you measure your financial situation. And as you go out into the market to start choosing what funds you are going to participate in, active is fun, it's aggressive, it is risky, it comes with its own negatives. Passive is laid back, it's accepting, it may or may not, it only returns the average. There is a middle ground there that you can decide and begin to play in, but you get to choose who and what type of investor you're going to be. So how do you build a portfolio? You started to see these big themes. Why are you investing? How long of a time horizon? And what are you willing to protect? The major ways you are going to be introduced to purchasing, and we're not going to spend too much time here today, are the singles. I can go and buy a single company, higher risk, higher return, but I'm not paying anyone. A mutual fund, whether active or passive, is going to have some kind of advisor fee to it and is a select amount of companies. And then the index fund, which is the largest, it just says, give me everybody in that quadrant, in that sector, in that asset class, put them all in there, don't pick and choose, and it is going to be the lowest fees and the biggest funding. So where and why index fund is a great place for you as a starter is because it will increase your diversification, decrease some of that risk, and give it time. It will decrease that risk even more without impacting that return. As you look at your portfolio today, you want to start constructing it not based on returns. Biggest counterintuitive thought you are going to hear today is the purpose of my portfolio, what I build on, is not based on the returns. It's based on the years it will take to produce returns, based on the years it will take to produce returns. So what does that mean? That means in my portfolio, I'm going to have to preserve some of my capital, hence the name capital preservation. This box is for when we break into a global pandemic. This box is for when inflation goes out of control and we need some extra funds in the short term. This box is for the stability and the brake pedal in our gas and brake in our investment world. The brake pedal is from the capital preservation. It is going to mitigate the risk of volatility right here. I want to remove some of the market risk in the chaos that ensues I get more capital preservation and more of my portfolio is protected from that risk. Go the other direction in global equities, more risk is going to mitigate the shortfall risk, the thought and the dread that you don't have enough in your portfolio in the long run can be mitigated by letting those dollars work. But what you need to point out on this slide is as I look at my portfolio, I am seeing all the investments that I have made. What time bucket do they fit in? Are they in that 1 to 8 year, that 9 to 14, that 15 plus? I need to understand from a perspective of time and control, that is how I begin to build. I have some cash and some cash equivalents in short-term bonds. I got some S&P 500, the United States equity market. Those are two teeter-totters, two barbells of my portfolio. Now I need to look at that 5 to 15 time period and begin to build some of those out, whether that's through those higher income, not as short-term bonds, but longer-term bonds. Maybe they're government grade, which is secure. Maybe they're lower quality, lower grade, higher risk, less secure, bigger payout. Maybe they're preferreds and have some form of bonds and stock tied to them. Maybe it's real estate. Maybe I look at this and I have some REITs, some real estate investment trusts, or even some single investment portfolio rentals, something like that. That could be in a different time horizon. But if I am building my portfolio and I'm saying in my 401k, I want to have stocks, I want to have equities because I need it to grow, I have to accept that 15 year. Could you say 10 year? Sure, you can say 10, but we saw in one of those earlier, 10 years significant, 15 year is massive. So as you look at this, you want to mitigate. I don't want the volatility of the market. I also don't want to run out of money. Those are the two things I got to counteract. Capital preservation secures the portfolio. Global equities creates the gains in the portfolio, but you need that through line and you need to be able to see it all the way. So as we wrap up, I'm going to go through two major kind of thoughts on how you mow your own grass, how you control the controllables. I love being able to share and show exactly what we want to do and what steps and actions you are going to take. So that diversification thought, the market leader doesn't always maintain, it's going to rotate, it's going to expire. So you have to diversify among asset classes, meaning I need bonds and I need stocks, and then within your asset classes. A bond can be 1 month or 1 year. A stock can be a small cap startup, or it can be a large cap Amazon. You have to diversify among your asset classes. Real estate's in there somewhere. And then within your asset classes, also practice diversification in there as well. I want some small caps. I want some mid-sized caps. I want some large cap stocks. I want some value stocks. I want some growth stocks. Looking at how you are able to diversify, that again is why the index fund is going to be a great starter for you. But if you are looking to be a little bit more involved and a little more active, you can begin to play it out that way. Understand the tax complexities. We're not going to dive too deep into these today, but the idea that if I'm an active day trader, every time I make a transaction, I'm being taxed at ordinary tax rates. It is being treated just like any other dollar I make. If I go over a year time period, now I'm in long-term capital gains. I'm taxed in a different category, potentially and hopefully at a lower tax bracket. So as I look at capital gains, I maybe don't want to make as many transactions to create as many taxable events. This concept of tax loss harvesting is one we'll have to address in another day. Mow your grass, control the fees, trade fees. If I do make a selection in my 401k, it should be a $0 trade. If I make it in my brokerage account, do they cost money? Is that charging me? I got to overcome that trade fee if I'm going to go make that in the long term. And then your expense ratio. If I'm choosing a fund or a portfolio or even an index, how much am I being charged to just simply enter into that fund? That's a big, big one. I'm going to highlight that here on the next slide. And then allocation. where are you funded? Where are you investing? I want to talk about 529s here in a moment, but allocation of which vehicle, if my goal is education for my kids, my 529 plan is going to be where I want those dollars to live because it removes some of the tax complexities. And last but not least, your emotions. Always, always, always have a plan. Remove your emotions. This is the biggest and hardest. It seems so simple, but ask people in 2020 when the market tanked, if they pulled out and missed the run back up, ask them right now as the market is unsteady and kind of volatile, do they have a plan, a strategy? Is that plan or strategy ending in 3 months? No, then why the panic? Quick calculation of what investment fees can make a difference over time. You will see the ability to say no fee, 0% versus a 1% on a $100,000 investment over a good amount of time. 25 years, your investment return, interest earned was 6%. Those fees are going to result over those 25 years because your portfolio grows with time. You get charged 1% with the growth. Again, investment managers and financial advisors are great assets and always good to have conversations. They need to exceed their fees with their value always. You'll see right there, the difference in a $100,000 investment ends up being $85,000 over that time period. When we talk about investing, we began with why do you want to invest? We're going to end with the idea that you can't compete or compare to anyone else's plan. The ability to measure your performance based on your performance in your strategy is paramount. Comparison is the thief of joy. You need to find a way to earmark and measure where you are based on where you are, not on where anyone else is. That is a big piece to financial freedom and success. Takeaways. Start today. Don't need to harp on this one. That's an easy one. Get time on your side. Begin to plan. Automate your savings. 10%, 15%, 5%, 35%. Get dollars going into this without hesitation, without thought. Maximize your 401k. Start to earmark other dollars to work for you. Look at the fees you are paying currently. What funds are you in? Who is advising those funds? How are you looking at your whole portfolio and starting to understand, where am I paying money? Who am I paying that money to? When I make an action, is there payment or fees going along with that? Diversify among and within. As you are able to look at a portfolio in its entirety, you can quickly say, I have no money for the next 1 to 3 years in the investment world. Sure, I have some dollars in my bank account, but if I run out of those, my capital preservation bucket is 0. I need to have some protection, whether it's just that 10% of your portfolio, but some protection there for a security blanket. And then as you look at within, maybe I'm looking at my equities, I need to not just have blue chip, large cap stocks. I need to have ones with a little more risk, ones with a little bit different reaction to different events. Asset classes at large move together, so you can begin to anticipate that and use that to your advantage. Use time. And then as we talk about finding a fiduciary, I'm going to show you quick ways or 4 different options people have to find an actual advisor. But as we look at the takeaway, I love this visual because it shows you what is your present choice? What dollars are you living on? That should remain somewhat consistent. It's your future choice that should change. If you make more money, your present choice shouldn't change. How much goes to the future, or perhaps how much goes to your past debts, that will allow you some change. So look at that visual. And then as you look to find an advisor, find somebody to help you with, you can do it on your own. You can definitely go about this, making decisions and finding and researching things on your own. You can use an app or some kind of smart technology that is going to guide you where you want to go. You can join a kind of a group or a class, and that's going to be an environment where you get a standardized kind of instruction for a particular section or age or group of people, and it's more in that classroom setting. Or you can go and look and say, I need that personalized education. I need somebody to help me build my plan. That's where that personal instructor comes from. I want to address any other questions popping into the chat function. I wanted to address one of the questions around a 529 plan. So 529 plan is going to be a designated investment fund that goes towards your children's education. Where you need to start to look at this from an investment portfolio, it should be set completely independent of your retirement or your other savings, because it has a different time horizon and it has a different purpose. That purpose is not to fund your freedom years, it is to fund the college. So what is that time horizon? I have an 8-year-old, I have 10 years before college. That is the time horizon before those dollars need to start being used. As my child is younger, I'm allowed to be more risk tolerant because I have time to negate it. As I get closer to college, I have to become more conservative because I don't want those dollars to dip right before I need them. So as we look at that 529, if your child is under 10 years old, be comfortable with the risk. As they get closer and closer year by year, start to sway a little bit more conservatively, a little bit more in that capital preservation. By the time they hit their freshman, sophomore year, you should almost be 100% in capital preservation, because those dollars are going to be utilized shortly. I don't know if that answered the question, but